Wall Street seems worried that Elon might actually cut Tesla's margins to zero. I know, crazy, crazy, crazy. They also seem to think that margins may stay, around the 20% level for the rest of 2023 or even longer. Well, could you please send this video to the people who think this way? They're completely wrong, and they're so wrong, it's even laughable. This is Randy Kirk. If you like the content, please like down below if this is helpful to you in any way. And then, of course, hit the subscribe button. And then I have some listings down below of upcoming shows, including Brian White, who will be joining me on Saturday morning to show what's going on at the show that he's attending over there in England. Fully Charged, that's the name of the show, and he'll be showing us maybe some of the new cars or some of the other booths that he is visiting that he thought were interesting. So hit notified if you want to be notified that that's coming up, and he may be on Sunday morning as well. Also, lots of Patreon folks joining recently, so please join the crowd, join the rush. It's only $5 a month. Okay. Bloomberg had a headline the other day. Then the CEO of Renault echoed it. They're now in the echo chamber. And they said that Elon Musk was betting the company on full self-driving. The idea here was that somehow if FSD and Robotaxi don't happen, Tesla is doomed. Yeah, that would be especially true with the price cuts now driving down the margins. Tesla is, how are they going to make money? It's such a horrible thing that they can't even imagine what's going to take place. And that, because Elon says, well, look, we'll just make the money next year. We'll make it up when people start subscribing and or purchasing FSD in record numbers, or when we start having robotaxis out on the road. So we need more and more and more fleet, because when that happens, oh my gosh, everything's going to change. Well, all that is true. Everything is going to change, but they don't need it. They don't need it in order to justify the current Wall Street prices and higher, much higher than they currently are. Why do I say that? Well, because nobody's figuring in Robotaxi into their models anyway, except people like Kathy Wood. So if they're not figuring it in now, why do they need it in order to justify current pricing? It's crazy. And I'm going to prove that today, okay? Some of the more positive pundits liken these cuts to Henry Ford when he wanted to make sure that every one of his workers could afford a car. Well, now Elon today, he wants to make sure that every person on the planet can afford a Tesla. And that is, there's truth to that idea. But the real reason that we had the price cuts is because Elon and Tesla need to move 500,000 to 900,000 more Model Ys in 2023 than they did in 2022. That is a lot. That is more cars than maybe 5 or 10 of the top selling cars in the world sell total. And he needs to add 500 to 900,000 more cars, not just cars, Model Ys, just one model. They're not making a lot more Model 3s next year, Model S's, Model X's, and they won't be making very many Cybertrucks in this year. And they certainly won't be making any of the new Generation 3 platform until late in 2024, going into 2025. No, it's all Model Ys. That's a lot of cars to sell. So given that it's a recessionary year, this morning, it was announced that we're now at 1.1 growth rate. That's the annual growth rate. You can call that flat. You can call that even. Who knows, with the adjustment that will be made in about a month when they do the second reading. Hey, it might be zero now. We still have 4% inflation. So that's a tough year. You could call that stagflation. I think it would be fair, stagflation. So we're in stagflation now, and you have these high interest rates. So you got all those headwinds, lower the price, and make sure that you sell all these cars. Now, one smart pundit called it the new pricing approach a reset. And I think that's about right. I think Elon is now ready to get it into the mind of the average car buyer, the average car buyer in Iowa. He wants them to believe that the Tesla is for them, not just for the elites on the coast. Okay. So let's go back to those geniuses at Wall Street. They've been downgrading Tesla stock all week. I think they've been 7 downgrades, all right, based on these assumptions. And while the accompanying stock drop is, it's upsetting to see that take place. And the stock drop on Wednesday was almost certainly because of some of these resets. And then the price has been down since the earnings call. And that is upsetting. And, it would be better if the price was going up. But the truth is, a lot of Tesla people love to see the price go down because then they can buy more at a lower price. It's a sale. In the long term, the fundamentals haven't changed at all because what? The prices will go back when the economy is back. The prices may go back way sooner than that. We'll talk about that in a minute. All right. The fundamentals will win in the end. So I decided it'd be fun to take a look at what would happen if Tesla actually took margins to zero. I think you'll be shocked. So let me share the screen and let's find out what happens if those prices go to zero. So as you can see here, I've got a very simple little chart. The Model 3 currently sells for $39,990. The Model Y currently sells for $46,990. These are US prices. These are without the discount. These are the retail price. If you go to the website, that's what it says. Now, $39.90 for a Model 3 is already under the average price for a car in the United States. In fact, it's about $8,000 less than the average price for a car in the United States. That's a pretty good deal. If you can buy the Model 3 with all the bells and whistles, the safest car in the world, super quick, cost you less in terms of cost of ownership going forward, save about $100 a month just on fuel compared to an ICE car. $39.90 is already a heck of a price. All right, now we're going to drop it here with the IRA. In the United States right now, most people that would be interested in a Model 3, a low-end Model 3, are going to get a $7,500 discount, putting the price at $32,490. Okay, now we're talking about bargain time. I mean, that's such a deal. I don't even know why there isn't lines and lines and lines of people already trying to buy Model 3s. I mean, that is really information that is not yet in the public sphere. People don't get it yet. That person I'm describing in Iowa or Missouri or Arkansas, they don't know yet that they can literally walk out of the showroom, $39.90. Yes, the $7,500 is going to come off their taxes when they file in 2024, but it's the same thing. They'll get that dividend next year. They'll be pretty happy to get it. All right. Now that changes in January. Remember that starting in January, that $7,500 will come right off the sticker, and they will pay $32,490 at the purchase time. So then that'll be in the loan. My understanding is that it will already be in the lease because the lease company gets that $7,500. So whether it's Tesla doing the lease or whether it's a third party doing the lease, they should already be figuring that $7,500 into the lease pricing. All right. Now, on the Model Y, we're talking about $46,990. Believe it or not, at $46,990 for the entry-level Model Y, that is under the average sticker price for a car in the United States today. I think it's about $700 less than the average price right now. If you go out and buy any kind of SUV or truck or whatever, it's going to be more, on average, it's going to be more than that. Now then you throw in the IRA, you're down to $39,440. So now you're $8,000 on a Model Y, entry-level Model Y. You are $8,000 under the average price that people are paying for a car. Again, it's kind of hard to imagine that Tesla's going to have any trouble selling cars at those levels. Now, we don't know yet because, again, this kind of information takes a while to get to the public. In 2 or 3 or 4 weeks, we'll start to see, is Tesla now selling out everything they're making? Are lead times starting to lengthen? I'm projecting that they will, but it does take time for the overall general public to get the news that they can buy a Model Y for $39,440. Crazy number. Okay, let's now continue to play. By the way, just as an aside, I believe that these numbers will begin to creep up, but they'll start to creep up when Tesla is selling out. All right. What if we took off another 20%? I mean, those are the margins, right? Right now, there's at the end of the quarter, margins were 19%. Let's call it 20% just for make it easy. So if the margins were 20% and we wipe out all the margins, that means that you would have a sticker price on a Model 3 of $31,990. $31,990. That would be a sticker. Okay. And on the Model Y, the sticker price would now be less than the number we just gave a minute ago in terms of what the Model Y is now after the IRA. You would have a Model Y sticker price of $37,590. Okay. Now I know that's crazy, but how crazy does it get? Okay. Now throw in the IRA. You're now looking at a Model 3 for $24,240 and a Model Y for $30,090. Let's be real, it would be $29,990. I'm sure Tesla would make sure that that happened. So you're now talking about both cars being under $30,000 out the door. Now that is pretty crazy stuff. That is not going to happen. There is no way that it will be necessary to lower it to those levels. I throw these out to you and say, can you imagine anybody buying any other car if those were the prices? So that would be zero margin. That would be zero margin, though, as of the end of the quarter. Okay. That would be based on the cost of goods in the first quarter. We know, based on the earnings call and based on reality, that commodity prices, the important commodities are dropping. We know that battery costs are dropping. We know that Tesla is making more and more Model Ys in the Austin factory. So therefore, the cost of each Model Y, as they make more and more of them, they all go down, reducing the overall cost of goods. We know that the more you make, the less percentage of overhead is making a contribution. And we know that the depreciation, they don't even call it depreciation, I'm sorry, but I'm forgetting the word, but the depreciation that they're taking based on all of the CapEx that was put into the Model Y in Austin, that number is also decreasing as you make more and more of them until they run out of that total. So the cost of goods is actually going down. So even in the second quarter, if you cut the price of both the Model 3 and the Model Y, as we've just outlined here, by another 20% and got it down to where it was zero margins, it wouldn't be zero margins anymore. It would have some margins based on this pricing differential that will happen in the second quarter, get maybe even stronger in the third quarter, and maybe stronger in the fourth quarter. But again, this is not going to happen. These prices are never going to happen. I don't think there's any reason to get them any lower than they already are. I would be shocked to see any pricing of any models drop by more than a maximum of 5% more. That would be like crazy. Don't expect it. Don't think it'll happen. But if it did, almost all of that 5% will be absorbed by these cost reductions over the next 3 quarters. But I don't think it's going to happen. So, and then we have the Highland coming out, which is supposed to be less expensive to build out of Fremont. So that's another thing that is going to cut into cost of goods, which will increase margins. So no, I don't think you're ever going to see a Model 3 for $24,240, but it is possible and still have margins. That's crazy. I know. Maybe even higher margins than the average ice maker. All right, let's look at a couple of thoughts that I had here. In the unlikely case that we were to cut all car margins to zero, all of them, across the board, they're not making 1 cent, they're not losing anything, but they're not making any money on the SEXY line. The company would still have income from the leases. They would still have income from the credits that they get from these other car companies. They would still, which is substantial. It's right around $500 million a quarter. They would have, call it $2 billion a year, or maybe a little less, but close. The IRA tax benefits, which will be increasing and increasing and increasing the more cars they make and the more batteries they make and the more energy storage systems they make, that IRA tax benefit will be increasing. And they would still, all of those would still even apply to auto revenues and profits, except for the energy. They would have revenues and profits from all the other activities. So you're talking about energy, you're talking about used car sales, you're talking about superchargers, All of these other activities are all bringing in money. And in fact, without getting deep into the weeds, I don't think you really want to go there. I came up that there's probably a total of $8 billion this year, or $6 billion for the remaining 3 quarters, but let's call it annualized $8 billion a year in gross profits from all of these other places. There's even interest there's even an interest factor that's in there for a couple of $100 million. So when you add all that up, let's call it $8 billion. Overhead is about $8 billion. So that means the company potentially breaks even in a year where they make 0 margins on the cars. I know, crazy, right? Wall Street doesn't know that. They haven't thought this through. They haven't done the math, but maybe you can send this to them and they can see the math. Now, all's not great, because if you do just break even and you're spending $7 to $9 billion on CapEx for all the new factories and all the new equipment that's going into the factories and everything else that Tesla is doing, you're spending another $8 billion, let's call it average $8 billion, spending another $8 billion on that. Well, then that $8 billion is still going to reduce free cash flow. And depending on other issues like whether inventory goes up or down and whether, there's a whole bunch of other things that apply to free cash flow. But for now, let's call it mostly CapEx. So that $8 billion is going to eat into the overall money in the bank, cash in the bank. Well, given that Tesla has close to $24 billion cash in the bank, they could take the $8 billion hit and still have $16 billion in the bank with no debt. You see, this kind of pricing power that they have compared to the other automakers, and this kind of balance sheet power, nobody's talking about their balance sheet power. They've got all this cash just sitting there that they can use to build factories. They can use it to do price cutting. They can use it to advertise if that's what they decide to do. Please see my video from Thursday night about a potential marketing scheme, advertising scheme that would not cost that much money. So anyway, think about that for a minute, that yes, they could take the hit for the $8 billion and still have $16 billion. Let that sink in. All right. So I don't think any of that's going to happen. I don't think that's going to happen. I think that they're going to keep the prices where they are and begin to inch them up. Why do you say they begin to inch them up? Because as the great Midwest and even the coasts see this pricing that we currently have, the current $32,490 for a Model 3 and the current $39,440 for a Model Y, I think that it's going to start to look like 2022 again, where there's long waiting lists. People are having to wait 2, 3, 4 months to get their car. And as that happens, Elon will begin to move the price up. 500, 1,000, 1,500, 2,000 will move the price up. And while that's happening, while those prices are moving up, the cost of goods is moving down, the overhead is moving down as a percentage. And so therefore there's more profit. I'm still looking this year for a minimum of $4 per share in profit, and it might even get to $5 a share in profit. I did a video on that earlier this week. Okay, that's my story. I'm sticking to it. You have nothing to worry about, and Wall Street is nuts as usual. And please, if you like this content, if this was useful, please like it. And then, you also want to hit the subscribe button and the notify button, and then join my Patreon. Yeah, come on now. I need a few more folks this week to join the Patreon, and thank you to all of those who have already done so. This is Randy Kirk. It's been great talking to you.
Click the link below to get your paperback, Kindle, or audiobook now.